afternoon, everybody, and welcome to what we hope will be the first of many webinar updates. Today, in our first webinar, we're celebrating 10 years since the end of the GFC, and we're asking the question, what next? We've taken a conservative approach to managing funds since the GFC as financial markets have recovered, but how should we move forward? How should we make sure that we're getting the most out of our cash holdings? How can we take opportunities in equity markets? And how should we position our investment portfolios to ensure that they can deal with any volatility that might emerge and is likely? For anyone in the audience who's unfamiliar with Prime Value, we're a Melbourne-based investment manager that this year we're celebrating 20 years of managing money. That's our own money alongside the money of our investors. Together with our sister company, Shakespeare Property Group, Prime Value is managing around about $1.3 billion in a range of assets, including Australian equities, property, commercial property, and agricultural assets. So let me just introduce you to the other members of our panel today. We've got Matthew Lemke here, who's got 15 years of experience in portfolio management and 30 years of experience in financial markets in a range of experience in London, New York, Singapore and Australia. He's the portfolio manager for our Cash Plus portfolio, which is one of the highest ranking cash funds on both the InvestSmart Morningstar survey. It's the #1 fund over 3 months, 6 months, 1, 2 and 3 years, and also one of the best, the top ranking manager on the Yield Report survey, which is one of Australia's most well-regarded interest rate reports around. We've also got ST Wong joining us. He's the senior portfolio manager and Joint Chief Investment Officer at Prime Value. He's responsible for formulation of investment policy and strategy. He's involved in construction and fundamental research. ST's got more than 20 years of investment management experience, and he's the portfolio manager for both the Opportunities Fund and the Emerging Opportunities Fund as well. So thank you, gentlemen, for joining me. Moving on to the first topic of our agenda, which is making your lazy money work harder for you. So I guess it's really important to identify or emphasize what we mean by lazy money, and that is money that's maybe not be working as hard for you as it can if it's invested, say, in term deposits or things of that nature. So I'll ask you, Matthew, first, why do you call the fund a Cash Plus fund? Is it actually cash?
All right, thanks, Fiona, and welcome to everyone who's dialed in. Okay, this is a really important question for people to understand. The fund is obviously not cash in the sense of notes or coin. It's not cash sitting in a bank deposit account. The fund has 4 main features that make it operate like cash, and this is why we are comfortable putting the word cash in the title of the fund. First, the fund is managed in an extremely low risk way, so investor money is protected and safe, and far more than if the money had been invested in property, equities or bonds. Secondly, all cash in the portfolio is held on account with major banks, and we do run a cash balance. And all securities in the portfolio that we own are held by an independent custodian, JP Morgan, which is a major US bank. And in this sense, all investments are actually held with banks, which should give investors peace of mind that their money is being held safely. Thirdly, investors earn a consistent and reliable return, which you would expect on cash. And fourthly, and this is probably the most important, it's like cash in the sense that we can redeem your money within 24 to 48 hours. So we believe that gives it the hallmark of being like cash. So it's as close as we can make it to cash in terms of redemption, return, and safety aspects.
So Matthew, why did Prime Value set up the Cash Plus fund in the first place?
Well, the history and rationale for the fund is interesting. Back in 2012, we saw a gap in the market with our clients relating to their cash. The gap was that banks were paying very little interest on cash deposits and term deposits and cash management trusts. And in fact, since we actually launched the fund in 2014, we've actually only ever seen rates falling as offered by the banks on their account deposits and term deposits. And the other thing with term deposits that's come into play in the last 2 or 3 years is that it's quite complicated to get your money back early, and there's all sorts of penalties and problems in doing that. So after 2 or 3 years of, designing the Cash Plus Fund and talking to a few of our investor clients and getting all the regulatory approvals from ASIC and other regulators, we launched the fund in mid-2014. And the idea was our clients can easily park money, secondly, earn a decent and safe return above normal cash rates, and they can get back 100% of their money quickly. And I'm pleased to say that basically the fund's met all of our expectations, hopefully investor expectations over the last 4 years. We haven't had a single mistake in terms of credit loss in the fund, a unit price that's practically had no volatility. And Fiona, I might just get you to throw up the chart on that so we can actually see that. Then we've got a chart that shows the Cash Plus Fund in yellow, and that's against the ASX Equity Accumulation Fund. We've also got our Prime Value Opportunity Fund, which is an equity fund. So you can see that the yellow line, which is the daily unit price of the Cash Plus Fund, has been slowly appreciating and very, very steady, almost, very, very little volatility. And I can say that the Cash Plus Fund, if I look at daily returns, has 19 times less daily volatility than the equity market. So in the strict technical sense, that's 19 times less risk than equities. I'd also like to say that we've earned 5% over the past 2 years, which is a very decent return, what we call cash, and it's almost double the term deposit rates. And on top of that, we've been distributing franking credits to improve the total return that investors have been earning. So all in all, we've been trying to make investor money work harder for them.
Well, that brings me to, basically what everybody here wants to know, which is how do you manage to generate higher returns than the typical cash rates that we can see in the market?
All right, I thought you might ask that. We've been hard at it for 4 years. We've achieved a really good track record, and there are a few reasons for that. We're delivering higher returns, but at no stage do we want to compromise the fund's cash-like qualities. So there's a real compromise that we don't want to entertain by driving for higher returns. First of all, we've taken a long time to carefully and methodically select the securities that go into our portfolio. And of course, that's a big reason for the higher returns. Currently, we've got 24 debt securities, and they're all hand-picked and relevant to what we're doing in the fund. We hold 0 equities, we hold 0 property, we hold 0 mortgages, 0 leases. We only hold liquid, transferable, tradable securities in the market, which there's a daily market price. And by debt securities, I mean securities where there's a known repayment date. So we know we're going to get our money back either from the issuer directly on repayment or earlier if we simply sell the security back into the market. Most of our securities are held in the wholesale or so-called professional market, not on the ASX. In the professional wholesale market, we can deal larger amounts of volumes. And all the debt securities that we own are issued by investment-grade entities, mainly banks like CBA and major financial institutions like AMP. Some are listed, the majority are in the wholesale market. And look, if I can just say, the gist of how we generate high returns is as follows. Say you invest in a 2-year term deposit from one of the major banks, and this involves, let's say, a return of 2.2%. That involves a term component, 2 years, and credit risk to the bank that they'll repay you. We do essentially the same by investing in the debt securities of that bank in the wholesale market. So we end up with the same credit risk as the term deposit, the bank, but we get a better yield because the wholesale market prices the yield on the security at a higher rate. And the important thing here is that TDs, that the bank is essentially setting the rate. It's a retail product, and they'll set it at the lowest possible rate because they know most people don't have access to the professional market like we do. Sometimes we add a little bit of extra term to further bolster the yield. The term deposit is a retail bank product, which is frankly where banks keep a lot of the interest earnings. they're pretty clunky, they're inflexible, they're hard to get your money back earlier, and there are penalties associated with that. And the reality is that the banks have designed them this way because it suits them. And well, for us, because of our size and operating in the wholesale market, for the same risk, we can add considerable return, which we can pass on to investors. Now, if I can just make a couple of other points, how we generate the higher returns. First, I mentioned security selection, but we also spend a lot of time thinking about portfolio construction. So the combination of all the securities that we have. And in that construction, we balance four things: maturity, a range of maturities from cash to, we even have securities up to 4 years, but we have an average duration, weighted average duration of 1.9 years. We balance yield, we balance credit risk, and we also look for that X factor, which is the diversification benefit that we can achieve by basically adding yield to the portfolio without adding risk. And in fact, diversification reduces risk. I also like to say the securities in the portfolio are all either rated investment grade or the issuer is rated investment grade by S&P, Standard & Poor's. So we're in the right place. We're not buying any second mortgages or leases. And the quality of security helps us generate returns and importantly maintain returns through time with no hiccups or problems. I also say all of our securities have market prices. We can sell them readily into the market, either the ASX or the wholesale market. And so that means we don't need to worry about trying to get out of illiquid investments where you pay a premium, and so we don't bear costs from that other cash funds, so-called cash funds, have, because they're invested in illiquid mortgages, property, car leases, I've even seen, and even staff loans. So this helps us generate what I call quality returns. And I'd also just like to add another point, which is we do maintain a reasonably large cash balance. This means we can repay investors quickly if they want their money back. We don't have to sell out of securities that are doing their job in the portfolio, generating returns. And so that way we avoid minimising having to go backwards and forwards into the market. That avoids costs and also helps generate those higher returns.
So Matthew, there are a number of cash-like products available in the market. Apart from the fact that you've generated such good returns, what actually differentiates the Value Cash Plus fund from other cash-style investments?
Yeah, so there's been a few cash funds, or cash-enhanced funds, they're sometimes called, sort of crop up in the market since we launched our fund. And I think there's a few things that differentiate us. And I'll probably name about 3 or 4, maybe a couple more. First of all, the things we invest in simply can't be accessed unless you sort of really know the market. I've been involved in the market a long, long time, both on the funds management side and on the origination side, where I was doing bond issues for borrowers. So I sort of know where securities are in the market. And I'll give you a really good example of this. We owned until recently a bond that was issued by Royal Women's Hospital. And this was when they moved from the city address to their Carlton address. It was used to fund their construction. As you know, the hospital's got a lot of government oversight and controls. It's administered through the health department of the Victorian government. There's a lot of government involvement. The bonds are not guaranteed by the government, but there's a lot of oversight. And we saw the bonds being traded at a very low price in the market, very high yield. And we saw this as a very high profile, critical asset delivering maternity services. We couldn't see any problem with repayment. The hospital has been performing really, really well. It is a maternity hospital. And so the performance has been really brilliant of the hospital itself. So we invested in that bond. It turned out to be really good. And it was unknown, a bit unloved, and we were able to generate some really nice returns. So I think that differentiates our fund from others. It's sort of, we're small enough that we don't have to buy a lot of very low rate, high volume securities, and we can hand pick, hand select some of these other sorts of securities that do exist out there. think another point is we deliver franking credits to our investors, which grosses up their all-in returns. A third point is that the cash fund's smaller, as I mentioned, so we're a bit more nimble in our security selection, both in entering securities and exiting them. And we're not a fund that's got hundreds and hundreds of millions in it, so we can be much more flexible than the bigger funds. And in return sense, we don't average down our returns because we're, of our size and inability to be nimble. I could also say that we're invested in securities issued by the major banks and financial institutions. We don't invest in car leases or property or second mortgages. I've seen in some cash fund portfolios. So that's another differentiating point. We're also only invested in Australian-based securities, close to home where we can monitor them. Some cash funds are invested offshore and there's all sorts of sort of monitoring risk and foreign exchange risks associated with those. And finally, we have the capacity to use financial derivatives, but we've actually never used, we don't intend to use financial derivatives, particularly to juice up returns, like I'm aware some funds have been doing. So that adds complexity, opaqueness to investors. We like to keep things very simple. Complexity makes things less understandable to our investors and also adds risk. And that's something we definitely don't want or feel we need to.
Okay, well, thanks for that, Matthew. And Matthew's just given us an indication of some of the strategies that can take place within this Cash Plus fund that enable him to invest in things that may not be available to the broader individual investor, and how that can help make any lazy money that you might have lying around work a little bit harder and get that additional plus in your Cash Plus return. I'm going to now move to the second topic of today, which is how to take advantage of opportunities in the equity market. And I'm going to pass it on to you, ST. My first question, this fund is called the Opportunities Fund. What does the word opportunities mean for you in the context of portfolio equity management? And what is the philosophy behind the Opportunities Fund?
Thanks, Fiona. Thanks, Matthew. Before I get into the opportunities and the philosophy of how we invest and how we see opportunities in the marketplace for ourselves and perhaps potentially for you, is to encourage you to participate in the webinar chat. Any questions that you might have burning in your mind, send it through. We'll try to answer those, and we want to try to make it as interactive and as engaging for you as possible. The Opportunities Fund was started 6 years ago, and the whole philosophy driving the fund is Prime Value has been operating its funds or managing its funds for the past 20 years. And that's pretty much based on the philosophy that in any singular investment that we make, the singular investment approach that we take is to, one, preserve capital and then to build wealth on that, which in simple term means that we don't necessarily look at it whether BHP, for example, is in the stock market index, for example. All we want to look for in a stock or an opportunity is to be able to generate a return for investments. And what this means really is to generate a positive return. So in that sense, we don't talk about indices. We don't really care in simple terms what a market does. What works for us is to look at singular companies, make out whether it makes sense from an investment proposition, and then to make a decision whether to buy or sell that stock within the portfolio. So Fiona, in that sense, opportunities could come from anywhere. It could come from a large cap company, a mid cap company, or a micro cap company. What we want to look for in a marketplace, in equity markets, is to look for opportunities for companies which are well managed, good business models, and over the medium term, generate return for our funds as investors. So Fiona, as you know, we are co-investors in the fund, and that makes a particular sensitive perspective for us that in any dollar that we invest in our funds, and the opportunity to look for in our companies, we want to make $1 and more in terms of return from that fund. So Fiona, back to you.
So I know that investing in equities is a long-term game, but just turning to the very short term, we've just passed through reporting season. I know you've had a very good reporting season in terms of the performance within the portfolio, but maybe you could share with us, ST, some of your takeaways in terms of the key themes or things we should be taking note of.
Absolutely. In a very short term, the market has been quite obviously dominated by the reporting season, and that's quite important. February was the key reporting season for a number of our companies. As Fiona mentioned, it's been a good one for us, and a number of our stocks typically do well through reporting season because that's when I guess a lot of value is crystallized. The key takeaways that I feel I want to convey to our participants on this webinar is that there are a number of positives we've taken away from the market, from a number of companies that are reporting. I'll just bring four for your consideration. And again, if you have any questions on some of the comments I make, please send through questions. I'll be happy to address them. First of all, is the resources sector, I think, continues to do quite well. The key point for resources, where the Australian market is concerned, is that cash continues to build amongst the big guys, BHP, Rio Tinto, and we're seeing that benefiting through as shareholders through increased dividends. That's number one. Secondly, we're transitioning to an infrastructure boom in Australia. What you see in Melbourne, in Sydney, a lot of work's put into the ground in infrastructure, toll roads, railroads, and we're seeing confirmation of that factor coming through in the companies that we invest in, and also the companies that we talk to. The downside, however, Fiona, this point number 3, is that costs are rising. We're seeing building material costs rise. We're seeing labor costs rise as well, and that has the potential both positive and negative impacts on the companies that we hold. And thinking about, for example, in the case of Adelaide Brighton, for example, that we hold in portfolio, we're expecting price increases to come through in the cement and aggregate sectors in the next 2 to 3 years, because demand for building materials is actually increasing on the ground. On the flip side, of course, if you're looking at property companies, they've had to deal with rising costs of construction, and that has potential for crimping the margins on that front from our perspective. The final point that I make, Fiona, is that there are a number of growth companies that we're looking at and quite excited on, both with companies operating within Australia, but also offshore as well. So we are quite delighted to see our companies growing well, reinvesting the profits into the businesses, and we're looking forward to growth in the next 2 to 3 years.
Now, SB, I know that Prime Value is a bottom-up or fundamentally based fund manager, but I know that you also have to take account of any sort of thematic overlays that might influence sectors in general. What are some of the key themes that you're looking at in terms of the macro environment, and what sectors and therefore companies might benefit from that?
Sure. From my previous points, you probably would have gotten some of those insights. One of these has been the rise of infrastructure investment in Australia. The fiscal lever is being pulled in Australia. We've transitioned from a resources boom 5 years back. We have transitioned from a housing boom last couple of years, and that seems to be plateauing or flattening out. The next 5 years, and perhaps beyond, will be about infrastructure. And that's a prime reason why we have chosen to invest in companies such as Downer, Adelaide Brighton. We invest in companies such as Seven Group, for example. These are prime beneficiaries of the development that we're seeing in rail, we're seeing in roads, we're seeing in airports as well. So that's a major theme that I think that will be quite prominent and will continue to be quite prominent in the next couple of years with Australian market is concerned. So Fiona, that's one key theme that I like to raise. There are a few others that's on the back of mind. I'll pass it back to you to maybe raise some other questions.
Okay, Steve, well, I probably think it's time to move on to the third key point for this webinar, And just as a bit of background information, when we were initially talking or planning for this webinar, markets were smooth sailing and everything was fabulous, and we were wondering about whether this momentum would continue and how to not be too complacent about markets. Well, certainly that's been given a bit of a blow with increased volatility in financial markets. So I'm going to ask you, Matthew, in terms of this underlying volatility that we've been seeing, how do you manage the risk of rising interest rates in the portfolio and make sure that the returns can be sufficient in a range of market conditions?
Thanks, Fiona. Yeah, look, I think the whole, thought of, need to create some agility in portfolios is really important. We've seen markets, if I look at the S&P 500, it's pretty much at an all-time high going back to, 1920s. And interest rates in so many countries, including Australia, are very close to their all-time lows, or have just sort of moved off the all-time lows, such as the US market has, and we're still sort of close to the lows. So it's tricky. A lot of those interest rate falls have been capitalised into asset prices, whether it be properties, bonds, fixed rate bonds, equities even. So I think the question's extremely timely, and particularly we've had a salvo across the bows, equity and bond markets, starting off this year with a lot of volatility. There was a big fall in both markets at the start of February. So things are looking a little trickier for investors in terms of where to go with their investments. And for those investors sitting on cash or possibly cashing out of the equity or property market, hopefully not ST's funds, but the problems that it's, putting cash into traditional cash investment products such as bank accounts or TDs, cash management trusts, it's really getting harder by the day. So it doesn't look good to take your money out of a market that's been doing really quite well into a market that's offering 1 to 2+% and no great prospects of rates moving higher here in Australia for at least I would say the rest of this year. So many investors are feeling a bit squeezed at the moment, whether you're talking to SMSFs or retirees and not-for-profits and other fund people that are managing cash, and quite justifiably worried about the negative carry, what I can call, of being conservatively in cash for all the right reasons, but not having anything like the returns on their investments that they've been used to. I think there are a few ways the Cash Plus Fund provides this agility to investors and put their money to work, but also keep the agility. First of all, the fund's ease and speed of getting your money back. I mentioned 24 to 48 hours. We've never failed to redeem investors outside of that time frame. So, inside that time frame. So, you can get your money back when you need it, and that's flexibility. We also offer a decent return. I talked about the 5% return we've registered over the past 2 years. I think our go-forward rate is probably more in the 4.5% range, but it's still well above term deposit rates and many other rates in the market. Secondly, the interaction with the rest of your investment portfolio of our fund does provide agility. The Cash Plus Fund dovetails with your overall investment strategy if you're running cash balances, or if you're in between, say, longer term investments in the share or property market. We also remove the hassle of investing in securities yourself. As I said, we've got 24 securities in our portfolio, and this provides you with agility. We maintain a very carefully constructed set of securities in a portfolio, manage up to 30, and this is probably not something you'd want to do or know about, or or even have the hassle of that. The sort of related point is that we use our specialist skills and knowledge. So I've got over 30 years experience in these markets, and that provides you with sort of vicarious agility. We've got access through our long-standing knowledge and experience and relationships through the market with brokers and banks and others that, just simply the man on the street or smaller funds, individuals, SMSFs just don't have. And I mentioned the Royal Women's Hospital bond earlier. So means we give our investors access to me. I'm very happy to take, phone calls from people, and I know bigger funds don't do that, but I'm more than happy to take calls from clients who want to know how their money's travelling, and provide a really family type service to our clients. And the last point I want to mention around agility is, sort of just where we are in the market environment. I mean, at some stage, Australian rates will probably rise. At the moment, all of the Australian government bond rates are below US government or treasury rates, as they're called, which is really unusual for Australian rates to be lower. At some stage, we would expect them to catch up, maybe move higher than US rates. I still believe in the cycle. There are inflation factors in both markets that are causing those different moves, and also the sort of the tax cuts announced in the US and the probability of budget deficits increasing. But I just want to say that we are mainly almost exclusively invested in floating rate securities. So that means we benefit from rates going up. So if rates were to rise, we're ready and positioned for that.
So it's a good thing.
Hopefully, and truly believe it.
Matthew, do you think that Australian interest rates will rise this year or next?
I don't believe they'll rise this year. We've had a CPI for the fourth quarter out in January that was below the 2% rate. It was 1.9% year on year, which was below the band. The RBA has an informal band that it manages towards. It's 2 to 3%, so it's below the lower end of that. If anything, they'd be thinking about rate cuts, but they're certainly not thinking about that because they don't want to inflate asset bubbles. So we get another CPI for the first quarter in April, so we've got a bit of time to wait for that till next month. And we've had, like, retail sales yesterday was on the weak side, so I just don't think we're anything like the US, which is in rate hike mode, and it's just a different set of circumstances. I must say that we lagged the US on the way down in interest rates. They had a much more precipitous fall. They were really much more hurt by the GFC than Australia, because we had China and record terms of trade in 2010 helping us out. And I think we'll lag the US on the way back up, and that's what's happening. So I think we will eventually have a lift off, but it won't be for some time. Whether that's certainly not this year, and I won't forecast next year, but I couldn't see it until well into 2019, to be honest. Maybe in the middle or second quarter of 2019.
When do you see term deposits going up?
Well, as a result of that, I can't see any need for the banks to offer a high rate there. As I said, they're a retail product. They control the rates of the wholesale market, so they can continue to actually probably lower their term deposit rates. And I think a few of them have got rates very close to that 2% mark. The problem is, to get the high rate, you've got to go out for 1, 2, 3, 4, 5 years, and that's a long time to lock up the money. If you go for 5 years, it might look good, but if rates rise, then you may want your money back, but then there's all sorts of penalties these days. So.
SB, if I could pass this topic of agility on to you. It's 2018 is shaping up to be a year of volatility, when a tweet by Trump or a move in the White House can elicit a big move in the market that we would normally associate with an economic data release. How are you dealing with this increase of volatility and positioning your portfolios so that it can continue to take advantage of opportunities as and when they arrive?
A great question, and a tough one to answer, Fiona. The first point I'd make is that we don't buy the market. So we don't own the market in that sense. That helps us get around the whole issue of where do we think the market is going to go in the next 6 months. Will it go up because Trump's putting through a tax cut? or will it go down because it's going to put through a tariff barrier to imports into the US? So first point to make is that whenever we're trying to make an investment, we avoid looking at the market because the market's pretty much just a number, it's an index. Our friends at UBS just did some calcs for us, and they believe that according to the calculations, we haven't had a correction of any sort in excess of 5% in the US market for over 400 days. And that's long and that's unusual. What I'd say to that is that 2017 was an abnormally low volatile, abnormally low volatile year. It is unusual. And this year, we should be expecting things to normalize. What I mean by that is that, well, things going up and down, share markets and stocks going up and down, that is a normal occurrence of what we deal with. One of the key questions that investors have, especially those who are looking at the market reasonably closely, is, of course, the ups and downs we've seen in January and February. So very strong January in equity markets, but February has been quite weak across the board in most markets. Of course, one of the questions that investors will ask of me is, are we at the cusp of a prolonged sell-off, for example? Are we, setting up for a better 2018? Again, going back to our point is that let's not look at the market, but let's look at fundamentals of companies on themselves and invest that way. That helps us to, avoid a lot of the noise in the market and focus what's important. And that's pretty much fundamentally, is the company growing? Are we getting the stocks at a decent valuation or price? And are we comfortable with the management which are driving these companies? That forms the core of how I look at companies and how I look at markets in general. And that helps me to, look for opportunity, especially when there's volatility. When stocks get sold down, be prepared with a list of companies that we're interested in surrounding these three areas: good management, the ability to grow the company, and certainly in the longer term, a good business model. And when stocks get sold off, be prepared to, bring out a checkbook to some extent and be prepared to invest for long term. That is fundamentally how we invest. And that, I think, will be the key factor driving performances in the next 20 months, next 12 months, basically.
Well done, team. We've got it in at 40 minutes, which is absolutely perfect. And it means that we can now pass on to the questions that we might have for some of our investors, for the participants. Now I'm going to stop sharing my screen so that I can go into see some of the questions that we're having. While we're waiting for that to happen, I guess I've got one for you, Matthew, which is, what if there is another GFC? How do I know that my money is going to be safe?
It's a really good question. Look, I'd answer it in the following way. A future market meltdown or a GFC type event is exactly what I'm managing the fund for and stewarding client money for. I'm not an equity fund. I'm not about chasing returns. It goes to the heart of what we're doing by offering the fund. It's absolutely no good for the fund to do, really well in the good times, and then when times get tough, we end up with a negative return. And we're well aware of this potentially happening. I mean, I sound like an old man, but I've lived through so many crises, going back to the late 70s. Oil crises, Thai baht crises, Latin American crises, tech wreck crises, GFC, October '87. They do exist. They probably will happen again. They'll probably be unexpected, and they'll probably happen whatever the media, banks, rating agencies, or brokers are saying. And so that I'm managing to downside risk. Safety of capital invested with us is absolutely paramount. We think of ourselves as stewards of client money. It's their money, not ours. We have and will be true to our word and absolutely respect the trust placed in us. And I guess just a couple of things just to wrap up my answer to you. We only invest in debt securities that we absolutely know. We've read the fine print. Often there's pages and pages of fine print. And we know that and they're put on custody with JP Morgan. So we know that we understand the securities, they're held safely, and we're operating under an ASIC approved product disclosure document. So, you know, there's everything is in that document in minute detail about what we can and can't do, and you can easily get that off our website. And the other thing is, you know, we report to all our investors monthly with a comprehensive set of, you know, facts and figures. There's no fudging, absolutely none. I write a manager's report every month. It's on page 2. And as I said before, I'm more than happy to take calls or emails from clients. You know, we're not hiding from anything, and I'm very happy to give my opinions. And if that means the client takes his money out, her money out, so be it.
Okay, I'm not seeing a lot of questions. Now, come on, guys, get those questions coming. I have had one, which is what is the minimum investment for the Cash Plus Fund, which I can answer directly. It's $50,000 is the minimum investment. But Matthew, you might to expand upon that if that's of interest while I'm waiting for some more questions to come through.
Look, we can take them down to 10,000. You know, that might be. I mean, actually, my mother-in-law's got an investment of $10,000. We do actually take investments down to $10,000. Where it makes sense for clients or investors will be up to them, but we are able to offer that.
Well, I'm still waiting for some questions to come through. While we're waiting for that, I'm going to ask ST, what are some of the, you mentioned that it was a very successful reporting season. What were some of the highlights in terms of the positions in the portfolio that did well over reporting season?
Thanks for the question, Fiona. One of the most interesting highlights for our fund is how pretty much the classics have come back for us. You know, in the last 2 years, all we've heard about is the millennials. You might not be part of it, Fiona, but you know, the millennials has been about websites, disruptions, how we all getting onto Uber, for example, and Uber's going to dominate the world. Likewise, Amazon. One of the most interesting investments we've made in the recent months has been Nine Entertainment Company, Old Style, free-to-air TV. I know you don't watch much TV anymore, but still there are people out there which have been watching TV. So sometimes sentiments swing too hard on to the other side. It's not about Uber, all about Uber. Channel 9, as you know, is one of the key assets which Nine Entertainment Company holds. Free-to-air TV, 3 to 4 years back, we're all talking about the demise of Channel 10, Channel 9, 7 Network as well. But it's come back very strongly. And the key reasons here are threefold. One, advertising on old media, old style media has actually stabilized and is actually showing some signs of growth. Secondly, some digital advertising is actually swinging back to free TV advertising, and that's positive for Channel 9. And the final point about Nine Entertainment Company is the fact that they have done well. Companies are driven by people or management, and management has been doing a great job in putting the right content onto networks. And as a result, viewership is actually rising. And what follows viewership is advertising dollars. That's how TV work or media works, basically. So all media, all style media has come back in a strong way for us, and that's been one of the key highlights for our fund, which I guess in today's context, when it's all about disruption, Uber and Amazon, it meant that expectations for Nine Entertainment Company was very low. We managed to purchase the stocks at a very cheap price, and that's done quite well for us in terms of an investment. So that's one key highlight for our fund. And likewise, we're seeing that theme play out as well. Flight Centre is one of our holdings. Flight Centre, as you know, is one of those red shops, one of those shops at the corner with a red banner, buying and selling air tickets for us. 3 to 4 years back, it was all about purchasing air tickets online. You know, companies such as Flight Centre, which is brick and mortar, end of an era for those guys. Again, old style has come back for us. The classics such as Flight Centre has delivered for us. in most recent reporting season. So what I'm saying, Fiona, is that sometimes sentiment swing too hard to the extreme. It introduces very attractive propositions as investments. If we're willing to take a longer term view, take a position on management, the business model, with the view that if management is strong, they will be able to drive companies and therefore profits. And that's what's happening with Nang Entertainment Company and Flight Centre for us.
Okay, I've got a question here from Simon. He talks about that we've talked about risks in the upcoming year. What are some of the threats to certain industries? And ST, how are you going to position yourself to take advantage or manage those risks effectively? What are I guess that is summarising that. What are the potential risks for markets this year?
Sure. I'll highlight two risks. One is, of course, the big macro risk, and jump in, Matthew, if you're inclined to share some of your insights. One is, of course, how quickly interest rate rise, and that's coming on back of how quickly inflation rise. That's a potential risk. The markets in general, in a broad sense, have baked in a 3-time increase in U.S. interest rate this year. It could rise more, not sure. That is potential risk for equity markets from my perspective. It's not so much about rising interest rates, but certainly the pace of increases has the potential to bring further volatility into equity markets. That's from my perspective. The second risk, and this is both a threat and opportunity, is, again, I alluded to the fact that operating costs in Australia is rising quite rapidly. Building materials are getting more expensive. If you run into Bunnings and you bought, say, a pile of lumber, for example, and you say bought a bag of cement for whatever, that's increasing. That's potential to crimp profits for a number of our industrial companies. But at the same time, for companies which are in the business of providing building materials or supplying building materials, that's a great environment to be in because it gives them pricing power. And that's why we've invested in companies such as Adelaide Brighton to tap into the potential improvement in pricing power.
If I could jump in there. If I could jump in just with my tuppence worth. The main factor or risk that we have in the Cash Plus fund is to credit spreads. As I said, we do buy debt securities, so they're influenced by the base rate and the spread above that at which the borrower borrows at relative to the base rate. So we're not primarily concerned about rises in the base rate because we benefit from that. But if the credit spread were to increase, that would cause a loss in the price of that security. We probably only get, credit spreads have come in a lot in the last 2 to 3, 4 years. So there's been a rally in credit spreads, and it would take a pretty decent economic downturn for credit spreads to rise, which would mean that a lot of the forecasts would be absolutely wrong at the moment. Secondly, bubbles. We don't invest in securities where that entity borrowing may be in a market that's overinflated or in a sector that's overinflated. So we pretty much stick to the banks and financial institutions in terms of the debt securities they've issued. And we do that because the banks have been really well capitalised. Since GFC, the regulators around the world have forced banks to add a lot of capital, and that gives them a lot of robustness, and they're well down the road in that. So if you look at the capital ratios of all the major banks here in Australia, particularly the Australian banks, they're all running AA- credit ratings, very well capitalised, and they can withstand a lot of downturn in whatever markets they're operating in, e.g. housing, mortgage market, whatever. So that's why we stick to that particular sector in the main.
Now I've got a question here from James. It's for you, ST. about the opportunities in the infrastructure market. James wants to know, isn't that already priced into equity prices at the moment, or are there still some opportunities out there for us?
Great question. The two aspects I think about where this sector is concerned is one, the duration of the investment cycle. That has a potential for I guess, stronger for longer scenarios we've seen in the past resource sector. So it's certainly one aspect which could still drive the infrastructure sector. Number two is, of course, I mentioned this, and this is quite critical, is that as we grow longer in the tooth where the cycle is concerned, where we want to focus on, it's not so much the companies where, it is driving off volume, but want to kind of focus on companies which are continuing to have the ability to price. And that's where the kicker will come in, where this cycle is concerned. So to mitigate our downside risk in terms of how long this infrastructure development cycle could go is to really focus on companies which will be able to put in price increases as demand increases. That means that profits will rise, and of course they'll protect us from the downside. And for that reason, that's why we focus on companies such as Seven Group, which I think Seven Group is in a business. Part of the key business is in the rental of equipment to companies which are building infrastructure projects. And I think as demand increases, companies such as Seven Group, which owns the franchise or the chain which rents out equipment, name kind of slips my mind at this juncture, but certainly the ability to continue price better into the cycle is where we want to focus our investment opportunities in.
Okay, I've got a question here about franking credits. I know both of the funds here talk about franking credits, but Matthew, maybe you'd like to expand, providing information on accessibility from a tax perspective and growth in these investments. How important are franking credits to the portfolio?
Yeah, look, we try and offer franking, buy certain securities that have franking credits attached, so we can, because we're a unit fund, we can pass directly through to investors. So all investors can, if they're a taxpayer, can offset the franking credit against their tax paid, so it has a real value. If you're an SMSF, it has a real value because you're on a lower tax rate than the 30% franking credit that's passed through. And if you're a not-for-profit or tax exempt, then that can have a very, very nice impact on total returns. And you get a very nice check back from the tax office, which is great. I'm on the board of a not-for-profit, and I know our financial manager is really pleased every time we meet or every time when the tax office returns the money to announce that. So I think it's something we use to differentiate from other, strictly cash funds. We don't think it adds any risk to what we're doing, and adds a nice extra between, let's say, almost 1% to the total return, which is really worthwhile in this current low interest rate environment.
Now, I've got a couple of questions addressing the same theme, so I'm going to put them all together and say, what is the view on the housing market for the next 12 to 18 months in light of the fact that interest rates continue to be low and don't look like rising anytime soon? Who wants to go first? I've got my own script. Matthew, maybe you go first.
Look, I'm not a risk taker. Nothing in the portfolio is directly exposed to the housing market. The only exposure we have is indirectly through the bank and financial institution securities that we hold. And as I said, those securities are issued by banks and institutions like AMP that are very well capitalised and in fact need to have certain regulatory capital so that they can't sort of fluff at the edges. So I think the fund, I wouldn't be taking any direct housing market risk. We own no property directly. We don't have any equities or interests in REITs or any mortgages. or any housing resi type direct risk. And I don't have a particularly strong view. I know we're in there seems to be a systematic rise in housing prices, and I know there's a sort of a, if I look at it financially, a sort of a tendency for our trending for prices in our major capital cities, Melbourne, Sydney in particular, to sort of gravitate towards housing prices in other locations, particularly in Asia. So people coming from Asia can sometimes look at our market and think it's cheap. I think we're in quite a strong, have been in a strong trend. Interest rate rises will definitely check that, or banks pulling back from interest-only loans or negative gearing.
ST, any views on housing?
Sure. From a property market perspective, this is a really critical point for Australian equities and Australian shares. I mentioned earlier in one of my introduction is that we don't own the market, we don't invest in the market, and that's one good reason why, and it's coming through from property market. Let me give you this perspective. 40% of the Australian share market index comprises of banks, major banks. 60%, 70% of the assets of banks are through mortgage loans. And these mortgage loans are leveraged up by shareholder equity. Is your money and everyone's money deposited into banks. And what I'm saying here is that there is a massive concentration of property risk in the Australian share market, which is why, in my view, you do well not to invest in the stock market index, but instead look for individual companies to invest in. That gets you around concerns of, I guess, any property market collapsing, if the market properly corrects, that is. And certainly from my perspective, this one key reason why our fund are not heavily invested into the market or the banking sector for that matter. So it is about avoiding concentration risk in our portfolios, and we see this flow through. It is one of the faults of the Australian market with such concentration in the banking sector, which in itself is highly concentrated in the property sector. So I don't take an active view on where the property market is concerned, but certainly from a portfolio perspective, these are some of the thoughts that I have to share where I guess portfolio construction is concerned.
Okay, I've got a couple more questions to go before wrapping up, but this is an interesting one about the US yield curve. A flattening of the US yield curve is usually or typically a sign of a recession coming up. What are your views on that? Is it a risk this time, or is it different this time?
That's a really good question. I think, yeah, the curve, if I look at the swap curve or the government curve, it is really flat. I mean, the 30-year US Treasury is only about a bit over 3%. It's about 3.14%, I think, at the moment, or something like that, and the 10-year at 2.81%. And you've got a Fed funds rate, which is their equivalent of our official cash rate at 1.5%, which is actually the same as our official cash rate here in Australia with the RBA. I don't personally think the US Treasury curve is sort of harbouring or predicting a recession. I think it suggests the Fed is not behind the curve. It's hiked a few times. I think it's 3 times, and it began hiking a couple of years ago. And that pace, as ST mentioned, will probably quicken this year. There's another 3 hikes priced into the curve. So that, and the strong US dollar necessarily will sort of burn out the inflation expectations that really drive the longer end of the curve. So I think it's more of a feature of the curve that inflation is more being addressed than it tipping over into some sort of recession. Now, if the curve were to invert, or if the Fed was to hike too strongly for the economics, then you would expect there to be some tendency to invert. So I'm personally watching that very, very closely because, as I said, the Cash Plus Fund is very interested in the credit market, which is very influenced by any recession that might occur in the US or Australia or anywhere else. At the moment, I have not seen one forecast that is suggesting a recession in the US. I think the tax cuts, the Trump tax cuts, certainly driving this next phase of growth. Plans to spend a lot on infrastructure that the Trump administration has will drive another sustainable form of growth going forward. Honestly, I think the US is just such a powerhouse economy that it would take a lot to actually put it into recession mode. But look, I'm very open to the question. I look at risk indicators all the time, and things that might sort of be the unexpected, and that's what I'm managing for. It's the unexpected that will disrupt markets, and you know, we certainly manage towards those.
ST, anything on the flattening yield curve in the US?
Sure. 2 points to make, Fiona. One is that, you know, from broad leading indicators that we look at, they're still moving higher. And these indicators typically roll over, you know, a year or two before recession kicks in, and they're not showing signs of that happening. From an equity market perspective, the concern actually is whether we have too much growth in the US economy. That's going to force the US Fed to perhaps raise interest rates much more aggressively than expected. That is probably the risk and the, I guess, growth dilemma the market's kind of grappling with at this juncture. So the underlying momentum for the US economy, as Matthew alluded to, has been strong for about 2 years now. Trump is putting more fiscal stimulus into the US economy, and that has the potential to drive the momentum even further. The market is probably quite unsure if this is too much of a good thing. And if it is, the market probably wants you know, some sort of dampening effect to come through. So at this juncture, whilst the broad yield curve is not too steep, equity markets are probably more concerned on too much growth rather than too little growth.
Okay, and I've got another question about franking credits, a very topical point, obviously, from this time from Adam, and it's a philosophical question. ST, how do you feel about whether companies should be returning franking credits instead of retaining earnings to compound and grow their businesses? What's the prime value view on that?
When I look for companies to invest in, I want my companies to grow in the medium to long term. And a lot of the growth options are, in many cases, organic. So they need to reinvest into their businesses. So in the medium to long term, retaining profits and reinvesting those proceeds into the business is a signal that the business is growing. And that, in my view, in general, is positive. Of course, what we look for is how those cash are utilized. Not all companies are good stewards of the funds that they're allocated to, and that's a key point. We look for management which are able to be stewards of our capital invested in those companies, and we want to see them utilized in a manner which are able to grow the businesses over the medium to long term. Because as shareholders, we want to see profits grow, and therefore capital appreciation and eventually being returned to us in form of dividends. So it is really top down. People drive companies. They drive how cash is utilized, and we look at where the cash go. And if we can't work out where the cash is going, we'll be pulling our investments out of those companies.
Okay, I've got a final question here, and it's related to the outlook for the equity market, but more specifically, as you mentioned, you're investing in stocks, not the market. So what kind of return would an investor look likely to expect from the Opportunities Fund over the next 3 to 5 years?
Well, what I can guarantee you is it won't look anything like 2017. 2017 was a year where the US market went up 22%. With absolutely very little downside. That's highly unusual, as I mentioned. What we strive for in the medium to long term is a return of 8% and better on an annualized basis. We can't guarantee that it's going to happen every year, but certainly from a singular investment perspective, if we look at BHP, for example, the question we ask ourselves is, can we get a return over the medium term of 8+%, 10% out of BHP in both in terms of capital appreciation and dividends from these companies? That's the question that we ask of each of our singular investments that we make. And of course, cumulatively, that makes up the composition of the portfolio. That's how we invest. We can't guarantee of a consistent 8% return per year, but certainly that's what we work towards in the medium to long term. This year, if I had a choice to put a stake in the ground, if I got a return of 8% this year in 2018, I'll be quite happy with that.
Okay, and Matthew, I guess for you, it's a little slightly different question because it's more related to cash rate, but if you wanted to adjust what investors might be likely to expect in the next 3 to 5 years?
Yeah, so our benchmark is the RBA cash rate. We try and earn what we call a reasonable margin above the RBA cash rate. The RBA cash rate's 1.5%. We've been earning about 3 to 4% above that. I think credit markets have been reasonably kind over the last couple of years. So I would think my go-forward rate would be in that 3.5% to 4.5% range over the next 2 years. I'd hope to be more closer to my running yield in the portfolio at the moment is 4.5%. And then, of course, you've got franking credits. But I think if we get a rate hike next year in Australia, it could mean rates sort of lifting to the top side rather than falling back.
Okay, that pretty much sums up our the questions that have come through. I'm sorry, excuse me while I just move through where we are. If you do have any follow-up questions that didn't get answered during today's webinar, feel free to pass them through. We'll be in touch with participants over the next couple of days, and you can certainly ask any questions in that forum. We're also going to be offering small group meetings, potentially a one-on-one with me, to anybody who's interested in a follow-up or finding out more about the portfolios or the prime value view. I wanted to say thank you very much to everybody for attending. We really appreciate it, and we'd love to hear any feedback that you might have on the webinar. And we certainly hope that you can join us for the next one. So thanks very much for attendance.
Yep, and I'd like to say thank you as well. I think we've got people up in Queensland, down in Tasmania, and from all over Australia. So thank you very much for taking the time to listen to us.